In the next few videos, we will cover a few popular option strategies. And as we go along, you'll get a feel of what exactly are we trying to achieve with these option strategies. And once you get a good hang of it, you will be able to create your own custom strategies, which in some cases might even work better than some of these standard option strategies. So let's begin with the first one called naked options. So, what is a naked option? Very simply put, if you are the seller of the option and you do not own the underlying security, it becomes a naked option. To put it more intuitively, think of think of selling an option where you do not have a hedge. So if you already own the underlying security, so let's take an example. You own the underlying stocks for a company XYZ, and let's say the total value of the stock that you own is 100 bucks. Now you sell a call option against that, again of value 100 bucks. In this case, you already have a natural hedge because as a seller of the call option, you want the price to be down. And if that call option strategy goes against you and the price goes up, you have a natural hedge because your cash position, your stock position, it will start gaining. So that becomes a covered option strategy, which we'll cover later. So a naked option, think very simply, is an option which you're setting up is a trade where you're setting up a single option position or maybe multiple contracts which do not have any hedge. And this is something that we'll use in practically every option strategy that we'll employ, one way or the other, which you'll figure out. So do not worry too much about the formal definition out here. We covered some of the option exercises in the previous videos, and most of the trades that you were doing, you were anyway setting up a naked option without even knowing that you were setting up a naked option. So the key is not really to know that okay, you're setting up a naked option. What you really need to understand is the risk and reward profile of any trade that you're putting up. All right. So what is the risk and reward characteristics? Now this is again something that we have already covered, wherein we know as a buyer of the option, buyer of a put option or buyer of a call option, your upside is unlimited. Of course, there are slight nuance if it is a put option because we know that a put option starts gaining value when the price falls below the strike price. Now the price can only fall up to zero. No stock can have a share price which is less than zero. So in a put option, your maximum gain is always limited to the difference between the strike price and zero. But yeah, practically put, your gains can be unlimited as a buyer of an option. But as a seller of an option, your gain is always limited to the premium that you have collected when you sold the option, whereas your risk is unlimited. Now, when do we employ a naked option strategy? So here is a deal. Even though this strategy carries an unlimited risk or a very high risk, it has a very high success rate if the strike price is chosen judiciously. And this is something that we will cover a little later, and we are going to cover this very extensively in the second part of this course, wherein we'll get into what exactly does it take, what are the considerations that we have to bear in mind before selecting a strike price and maximizing the probability of our trade, maximizing the win probability of our trade. Risk reward considerations we've anyway covered. You understand what is the maximum reward and what is the maximum risk in this case, in the case of selling an option as well as in the case of buying an option. So if you're a seller of a naked option, you anyway have maximum risk. So it's almost impossible to derive a risk reward ratio out here. But this is something where you're just setting up a trade, keeping in mind that your probability of success is very high, and you're going to be employing certain ways like stop losses to limit any potential downside beyond a point, which is your risk appetite. How exactly do we do? Okay, so let's take an example. The stock name out here is Nifty. Nifty, for those of you who are not from India, Nifty is Indian Stock Market Index. So let's say we are selling a call option of Nifty, and the current spot price is 10,714. So we have chosen a strike price of 10,900 because we have figured out from all our calculations, all our considerations, that the price is highly unlikely to breach past 10,900 within the duration of this contract. And we collected a premium of 47 bucks per share, which amounts to a total value of 3540. And we've already covered, just like we've done it before, we create an entire P&L scenario with various closing spot price scenarios. So we see out here that if we have sold this option, then we are not going to lose any money till the price hits 10,947 bucks. So I will only be, as a seller of the option, I'll only be losing money after 10,947. So the risk and reward scenario is very intuitively clear here. If we just eyeball that, in this case, from this point downwards, okay, so here I've just used a formula. So you see a value up to 914, and the next value is 964, 10964. But so somewhere in between is our break even point. So from that point all the way down is a good scenario for the seller of this option, because he gets to pocket the entire premium and he's making money. But if the price were to go beyond this, the seller will lose money, and this represents the gain scenario for the buyer. Now, another interesting point really is that if I were the buyer of this option instead, I will be choosing a very different strike price. And most likely, as a buyer of the option, you would be selecting a strike price which is at the money. And very similarly, so the put option, the very same considerations like we've done before. A put option will, as a seller of the put option, you want the price to stay above the strike price. And as a buyer of the put option, you will want the price to fall below the strike price and even cover the entire premium that you paid to purchase that option so that you can make profit. So this is the profit and loss scenario. So wherever it is showing plus, out here I've calculated the P&L for a seller. So here the strike price is 10,400, because if I'm the seller of this put option, I want to ensure that I'm selecting a strike price such that the actual price, the spot price, the likelihood of the spot price falling below that strike price is very low. So I've taken a safety cushion and I've gone as far down as 10,400. And if the price stays above 10,400, even if it were to fall to 10,400 less 53 bucks, as a seller of the option, I'm quite good. So you can see out here, somewhere between this point and this point is our break even if I'm the seller of this put option. And if conversely, if I were the buyer of this put option, I will start making money only after this break even point for the seller. So hope this is clear. This is the basic building block of any of the option strategies we deploy. And once again, to summarize, a naked option is nothing but an option trade that we are putting up which doesn't have any natural hedge. All right, so I'll see you next in the option strategy called covered call.